Hi, everyone. Welcome. I'm very excited today to be joined by two fantastic people. Todd Bix here at Bernstein. He is a senior investment strategist and head of credit for AB. And then Kendall Rawls, who is the director of development for the Rawls Group. And we're going to spend today very briefly talking about the current state of the market, which has been very eventful recently, the economy, and then how, as auto dealer owners, you and your employees can be best informed and educated on this market and what actions you can be taking. So before we get into things, very briefly, Todd and Kendall, I'm going to ask you to introduce yourselves and talk about what your role is, and then we'll go from there.
Excellent.
Do you want to start?
Sure. I'm Kendall Rawls, Director of Development with Rawls Succession Planners. The Rawls Group, we work with car dealers across the country with growth and transition planning. So whether that be wanting to pass it on to the next generation of family or key leaders or figure out professional management to keep it within the family, we work with you and your key leaders to create options so you can fulfill your long-term goals.
So I'm Todd Bix. I'm a senior investment strategist with Bernstein's high net worth group. My job incorporates anything with the markets, so a market generalist. And then on top of that, I have a specialty in anything that delivers income. So think cash and bonds, and then alternatives that deliver income. My role is to be someone who answers a lot of questions. So whether it's a prospective client, a client, or an advisor, I support them in delivering the message and creating portfolios so that someone can accomplish their goals and objectives over whatever time horizon they have.
Yep, and that is a very good lead-in. I'm Hannah Sears. I am a financial advisor here in the Nashville office and a member of our auto dealership practice advisory team. So to kick things off, Todd, I'm going to start with kind of the question of the day, which is for many of our viewers, they're watching the news, they're watching what's going on in markets, and they're business owners. So they're very focused on everything that's going on today, but there's a ton of news and it's hard to cut through and pay attention to what's real. So can you do a digest of the market today and what has been going on with tariffs and bring us up to speed?
Sure. So I'll start really high level and then we can dig down a little bit. So the market will price into investments whatever news is available. So we think about what happened in the fall, leading up to election day. Mm-hmm. Markets were pretty positive. Both stocks and bonds had positive returns. The anticipation was that the Fed was going to cut rates because inflation was coming down. That'd be supportive. We had really good growth, very low unemployment. Things were great. When President Trump was elected, the perception was the red wave. It would be the Republicans control the Senate and the House and now the executive branch. And what would that mean? Well, he had an agenda, and we knew the high points of the agenda, but we didn't know the details. We knew that he wanted to embark on more tariffs to bring down tariffs from countries that had tariffs on the U.S. And tariffs are inflationary. So if you think about selling cars, if I've got a set price, I'm buying it at X, and the tariff is 20%, now I'm buying that car. When I import it, it's 1.2x. Mm-hmm. And that 0.2 is either going to be eaten by the dealership or by the consumer, or split. So with the belief that tariffs would be inflationary, now the belief that the Fed would be cutting rates went away. The belief that that was really good for the U.S. and bad for foreign markets meant that U.S. stocks did well and foreign stocks did poorly, and the dollar strengthened. Yep. Now, that was November and December. Mm-hmm. And then from January really through the Rose Garden, maybe a little bit afterwards, that's when everything reversed. The dollar weakened, was weaker than where it had strengthened to. U.S. markets rolled over. Non-U.S. markets did really well. Why? Uncertainty. So if you're talking to a potential car buyer and they've got a price in mind, and you have a price in mind, they're not going to tell you exactly what their price is, because then you're just going to go to that price. So the issue we have right now with President Trump is that I can't define, I mean, I don't know if you can define what's victory. No, I'm saying, what's victory?
I'm with you. It's hard to know.
He wrote Art of the Deal.
Yeah.
And if he wants to buy your car for $20,000 and he offers you 14, he's not going to say, but I'll go to 20. So right now the market's grappling with how much would the tariffs be? How long would they be there for? Who would it impact? When would there be deals? So I'm sure you all watched what happened back in the Rose Garden where the markets dropped almost 10% in a day, which is pretty historic drop. And yields moved all around. People were scared and were reacting to that. It was because I couldn't define for you, the market couldn't define, when would this end? Would there be agreements? And part of that was also because we all kind of consensus thought that it'd be 10% tariffs across the board. And maybe a little bit more for China. We did not anticipate 10 to 70% on 70 countries at once, and then 100+% more on top of the 25% tariffs that were on China already. All that meant that there was so much uncertainty that you couldn't value things. I mean, if you didn't know what your paycheck was going to be month to month, how can you enter into loans, et cetera? So there's a lot of uncertainty. So the market was digesting the uncertainty and using the data points it had, which was 20 to 70% tariffs, never going away, sell everything, go to cash, be very scared. Since that time, things have gotten better. Why? Well, part of it is because someone in the Oval Office blinked several times. Right after that, we saw what happened to yields. We saw what happened to, so bonds sold off, definitely saw equity sold off a lot. Then we delayed for 90 days. We talked about exceptions to some industries. I mean, you're all involved in the car industry. You know that in manufacturing a car, a part of that car can cross over the Canadian and the US and the Mexican border multiple times. There are some cars that will get assembled in Korea and then come back. So that's a lot of tariffs you have to figure out. I definitely think that's the impetus for the UK deal. Why? UK is big in steel and big in autos. And look, they're on the brink of recession. They're not growing. They have lots of unemployment. So lots of issues there. They had to come to the table. They needed to do that to protect their industry. So now we've gotten all these delays and potential industries or different parts, auto parts, are being exempted. We're talking about letting all autos be off of that except for Europe. And, so if you're a BMW salesman, probably not the best thing for you. Yeah. But if you're selling cars that are manufactured in North America, might be better for you. So it's really the market grappling with the data points you're getting. And each time he delays, I have a little bit more certainty. Or if there's a deal that's announced or rumored, you can see the market moves when Scott Bessent comes out and starts to talk. Things get better. Why? Because he's placating the market. He's giving them a little more data points. So it's all about uncertainty this year.
Yep. Okay, so you've talked a lot about the market and it's very reactive. Talk a little bit about the economy on the longer term and what you're seeing there if you pull out your crystal ball.
Sure. So we talk about the economy and growth in terms of gross domestic product. And here in the US, we're the one nation that quotes, what is this fourth quarter over last fourth quarter? Everybody else looks at the whole year, which to me makes perfect sense. I want to know what you did all last year and what you're doing this year compared to it. But we do fourth quarter. Because last year, second and third quarter, we had GDP growth of over 3%. Really strong. And if you think about the long-term trend is 2% plus or minus, if we can get back to that, that's a healthy economy. As soon as the trade and tariffs went into place or were announced at the Rose Garden speech, our economist took the data points he had, and what did he do? He knocked down our expectations for growth, which we thought would be 1.5%, 1.6%, down to 0 to 0.5%. And in any given year, he would predict, even if it's a really good year, unemployment's low, growth is high, he'd say there's a chance of 10 to 15% chance of a recession. He brought that chance up to 50%. Then when he delayed down to 33, now he's at 40. The risks are higher because the uncertainty's higher. So what do I think? Look, I'm not a psychologist, but I have to kind of get inside the Oval Office and try to think what this individual's thinking. And it, having lived under his presidency before, I would find it hard to believe that he could stomach both a recession, because that's a failure. You put the country into recession, and a bear market. Bear market definition is when the market drops 20% or more. I think that would be hard for him to do that. I also think that he has a mandate that is 2 years long, midterms. Yes. So when election happened, I had two calls. One was, get the Dom Perignon, it's time to party. The other one was, where's a tall building I can jump off of? And I said, look, number one, he's not even in office yet. Number two, it's not a red wave. I thought it was a pink wave because, look, it's a slim majority in the House and the Senate. We just had someone arrested on the Republican Party on the Senate. So who knows how long this will maintain? And remember, he campaigned on lower prices. Both of them campaigned on lower prices. Yep. Lower prices doesn't mean inflation comes down. It means prices drop. Inflation just means the change in some reference price year on year or month on month. Yep. In order for prices to fall, we would have to have deflation, which is bad for an economy. A little bit of inflation is healthy, but deflation is really bad. The only reason why gas prices have gone down is because the expectation that tariffs will slow growth and there'll be less demand. So if you look at the forward curve of how oil is priced, it's gone down. Why? Less demand. Yep. We also have OPEC is starting to pump oil again. Why? To bring some of those nations that weren't living by what their quotas were, say, look, we can do this longer and survive longer with lower prices. And the other one was egg prices. Yep. So we killed, 20 billion chickens because of avian flu. You know how long it takes a chicken to grow until it can start laying eggs?
I don't.
It's like 4 to 5 months.
Really?
And now all of a sudden, we've got eggs.
Oh.
So if you start, thinking about this, he's taking credit for a lot of the headlines, but I just don't think he can be so hell-bent on, having this trade and tariff war. I'm not the president, so I can't say I'm smarter than the president, but I probably wouldn't have taken on 70 countries at once. I probably would have tackled the larger ones. Or gotten some agreements in place before that happened. Israel dropped all their tariffs before all that stuff was announced, and they still got hit with tariffs. So, I think just a lot of uncertainty. But I think that we'll have below trend growth, maybe 1%, maybe a little bit below that, but not recession. We could have a negative growth quarter, depends. And I don't think the Fed is going to do much of anything. Our economists and the market thinks 3 to 4 cuts. I think 1, maybe 2. Why? Because we're not at 2% inflation, and we are at full employment. Yep. I mean, you're all working, you all have jobs. Unemployment at 4.2% is extremely low, and one of the reasons why it's ticked up is because more people are coming back because they think they can get jobs. So, I've got a below trend growth, but positive growth for the year. And I think that we will start getting some announcements on trade and tariffs. It just takes a long time. These agreements can take years. So the initial ones are kind of like, we've agreed to agree, I think.
Yeah, they'll start coming through that way. So for all of our listeners, they are both business owners and investors. So you painted sort of an optimistic picture, but everybody is always looking for opportunity beyond that GDP growth rate. So where are you seeing opportunity? Where are you telling folks to focus as investors?
Now, the caveat will be, or I'll put an asterisk on it, I am the bond guy, but bonds are cheap.
Yep.
So if you think about a municipal bond and a taxable bond, if you're paying taxes, I have to adjust the yield on the taxable bond to say, what's the tax equivalent? At one point, because of what happened in the Rose Garden, a 30-year AAA rated treasury had almost the same yield as a 30-year AAA rated municipal bond. But I have to tax one. So municipal bonds, which you get double tax-free income if you buy them from the state you live in, or if you live in Tennessee, you don't have to worry about state tax. They're cheap, and they tend to outperform when they're this cheap. So that's one place, and it's pretty safe. Because if we look at equity returns over the next 10 years, and we're kind of talking about a normal distribution. You remember back in school, you had the curve, and that was the C. in a typical market, we think equities over the next 10 years do 6 to 7%. That's not much to get excited about when over the last decade we've done 9 plus.
Yeah.
If I can get 4 plus and I don't have to pay taxes on it versus 6 to 7 and I could have the markets fall 50% in a year or 9% in a day, you start thinking about how much return do I get per unit of risk? Bonds are smart.
Yep. What about the private markets?
So the other thing is that private markets, so when I invest in the private markets, I'm investing in something that there's no ready market for. So you can buy a bond that's issued by GE or GM or by Apple or whatever, and there's a ready market for that. But if I'm buying or trying to buy a loan that a company used to buy a small company that maybe generates $25 million worth of free cash flow in the year, do you want to buy that loan? It's hard to find. So as a lender, a direct lender can make those loans. They'll price those loans based on the ability of the borrower to repay, not based on what's the next executive order or is there a trade and tariff coming out. Now you've got to look at that loan in the backdrop of will tariffs impact things, but you don't have the emotion of the markets. I mean, if you think about what happened in 2022 when rates went up so dramatically, the Fed said we're going to raise 1 to 1.5%, and they raised 5.25 to 5.50. Everyone was off sides. You can't adjust to that, especially with bonds that pay a fixed coupon. So if that's really in my mind as a retail investor, and I'm looking at what's happening back in April, what happened? People sold bonds, sold lots of municipal bonds, because retail investors are 55% of that market. They panicked. You can't sell these loans. So you don't price them on a daily basis based on fear or greed. Those are the two things that really drive the market. So if I'm only pricing them based on what current rates are, I make the loan at the beginning of the year, they're floating, and I can get 5% above the floating rate. At the end of the year, I can get 10%. That loan will be worth less. But I'm still getting paid. So I don't have the same volatility. So we think private markets are cheap and attractive, especially if I can get a return that's equity-like or better without the volatility. So it's okay for me to be illiquid as an investor. We would never say put it all into something that's getting 10% returns, but it's illiquid because you may need it. When I have clients that say, oh, I can do that, I say, as long as you promise me, nothing will change. And if you're running a business, you know you'll never tell anyone that nothing will change. So if you can't plan that way, we got to plan what's the right amount that can be illiquid to get you those higher returns that won't have the volatility so that you don't panic with the equities, which can go up and down a lot more, or with bonds when rates go up.
Yep. And of course, when we talk about all of this, these are fitting into a diversified portfolio, but areas where there's specific interest today.
So if you think about what happens when people panic, they want to be liquid. So something called an illiquidity premium. If you think about, if I plotted in a normal market what the Fed pays on overnight deposits, 2-year, 5-year, 10-year, 30-year bond, you should get paid more to lend your money for a longer amount of time. So if I'm lending, I should get that premium. Or if I want to be liquid, I should accept a lower rate of return. That's the liquidity premium. You're giving up return to do that. In the markets, there are many investments that are longer term, have lockups. I can't get out of this until a certain time. I'm in a lease, you're gonna have to pay something to get out of a lease, right? So if I'm in this strategy, but I need the money, I might take a haircut. So I'll sell it to you for 15%, 25% discount, whatever it is.
This is exactly what we saw a couple of years ago.
Right, so secondaries funds will deal with portfolio managers that run a hedge fund, which is kind of it's like running any mutual fund, et cetera, but their rules are different, and you can make different bets, and it's for qualified purchasers and things that have levels of wealth, et cetera. Those individuals that are making those bets, if they know they have redemptions coming, hey, I know we have a bunch of leases expiring. We're going to have a lot more inventory. I'm not going to probably buy a lot of cars. Because when we're looking at the prices, you could do the math and you could decide, hey, we're probably going to get a turn-in rate that's higher than normal. Well, same thing. If the markets are poor or performance is poor, that hedge fund manager says, ooh, at the end of the quarter, I'm going to have to provide liquidity. You have to sell something. Yeah. So they may sell things that they carry at below their cost rather than what they've appreciated to at a nice discount. And because an investor has the liquidity that it can provide to them, you get that haircut and you can get really nice returns, much better than equity returns. Yep. So in an environment where people want to be liquid, if you can provide liquidity, you can extract a price. When I talk to clients about a strategy like that, a secondaries fund, I say it's going on offense. Yep. Why? Because you're taking advantage of someone else who can't be as illiquid and needs liquidity, and you can grow wealth by being illiquid.
Yep. Be what other people can't be. Yep. Well, I like something you said earlier, so we're going to come back to it about fear, because I think that's a big component when we talk about advice you can give to the average investor. So we'll come back to that, but I want to change gears, and I want to talk about, from your perspective, Kendall, there's so much uncertainty going on in the market. What are you seeing dealers and dealerships coming to you about to think about their strategic planning and their succession planning in markets like this?
Yeah, absolutely. So, and as you mentioned, fear. In times of uncertainty, there's a lot of fear and anxiety, and that happens from the top down, from the dealer, CEO, key manager, employee, and even your customers. So customers are feeling fear and they're wondering, can I afford a new car? Should I make this investment today? Your employees are looking at the markets and going, is my job secure? Yeah. What's going to happen to this business if people don't come and buy cars? Am I going to have to be looking for another job in an environment where maybe employment's going to go up or unemployment's going to go up? So something that we're sharing with our clients and with dealers across the country is that right now, strong leadership is one of the most important things. Yeah. And one of the key functions of strong leadership is communication. And as the dealer talking to you directly now, you may be going, well, I'm watching 24-hour news. I'm watching all of the pundits and their opinions and how they read the market, and I don't know what to do. And if you're feeling that, then this is the right time to reach out to your strategic advisors. For example, people like here at Bernstein who know and can tell you what's happening in the markets, what's happening, and what your options are from an investment standpoint. So you're cutting through the flack, you're cutting through the news, and you're getting it directly from the expert source. Additionally, partnering or looking directly to experts like NADA. They have a ton of resources and numbers. And so if you find yourself spending your time on NBC or CNN or Fox News, yeah, that's information, but is it just anxiety-driven information? Is it information that you can take control of and really look at your unique family, business, dealership environment and make some strong decisions? Further, talk to growth and transition specialists like us, or if it's not us, go to someone within your in your community, whether it's NCM or Hague or Presidio. All of them are expert car people and can give you strong insight into what are your options and things to think about. And so from there, as the dealer, once you fully understand your environment, the industry, the pros and cons and the opportunities, then begin to discuss these things with your key leaders, because the key leaders are nervous. And if you're not engaging them in conversations and really thinking about what are some next steps, what are some things that we can think about in our organization to plan forward, they're also wondering about their future. And then from there, strong leaderships from the top down. Yeah. So have your key leaders then communicate to their managers, give them some scripts that they can also communicate to the employees. And even further down the line, this is a great opportunity to use it as a, for lack of a better term, a marketing education opportunity to consumers. That, hey, we're getting this from the experts, from AB, from NADA, that this is what you can expect. And a educated market, especially from a car dealer, that's just a sticky marketing opportunity to pull the community together.
I love that. You just said something that I think is so key to what both of us do, which is the planning component, where, and I think this is something you guys do so well is you have a plan in place so that when things are happening, you already have a roadmap. And as the business owner, you can make tactical decisions and you have the tools in your toolbox and the people to reach out to who will keep you on that roadmap and that growth map. So I really like that. Obviously, and you touched on this a little bit, morale in a time like this is not high because, like you said, the news is scary. People are feeling nervous about their jobs. What are some tips and tricks, things that you've seen dealers do really well to keep morale high and keep people engaged?
Yeah. I think helping your employees and managers and key managers be part of that strategy process. So something that I talk a lot about, and we have a ton of tools and resources like worksheets that I can provide you that you can facilitate on your own with your management team is, so we kind of know the state of the union today. We knew what it was in November, it's changed, and it's likely going to change again. So you can scenario plan. So think about what it is today, what is a not so great environment, and then what is kind of in your mind what you can create the worst environment. And by really putting yourself and thinking through that, begin to discuss with your key management strategies for overcoming those. And what I like about this is that it puts you in control instead of, lack of a better term, fear-mongering about, oh my God, the sky's falling, this is going to get worse, what are we going to do? If you've already imagined the worst case scenario, sit down with your management team and strategize what can you do to overcome them, and what are kind of those key red flags that you're moving into that environment so you know exactly when to deploy that new strategy. So it's really about what can you do now, given the information you're getting from experts, not just the 24-hour news cycle, and given your unique family, business, environment, and community, how can you strategize ahead of time so you can just flip the switch? And by doing that and involving your team, now they have ownership over it. That puts them in a position of feeling like they're in more control of the situation versus just feeling like they're going to be the victim to an environment that they can't control.
Yep. The more engaged the employees are and the more they're part of it, probably also the more they'll be invested in achieving it too, which is so key. So that ties a little bit into, in environments like this, especially for owners of businesses where you have a number of employees, where it's really important that they also stay on track financially. If you were Todd, a dealership owner, and you were thinking about your employees and the really fundamental things they should be doing at a time like now from a financial perspective, what would you put on that list? And I have some ideas of my own.
So financial planning 101, well, I mean, it depends on the dealership, and I don't know if all of them match or anything, but like just because you're worried doesn't mean you shouldn't continue to save in your 401k, especially if there's matching. This is not a public stock type of environment, but if you can buy public stock at a 15% discount, you should do that every day and on Sunday. It just makes sense. You're locking
Stocks are
in
on
money.
sale.
So if there's a way, if I know I have to maybe save, maybe cut back on my budget because I'm worried and I want to have some money set aside, I would make sure at least I meet my matching. Just at a minimum. That should be something you always strive for. Also, you should be thinking about, do I have some spending money set aside in the case of an emergency? Because you don't want to put yourself or your family in that situation. I once had a client who said, he said, look, I have 3 years of spending money in cash. And I looked at him, I said, why? He said, well, because my wife can't sleep at night if I don't. I said, so we kept talking, and then his wife started to come in, and she said, what's the right amount? I said, 3 years spending money. He said, why? I said, because your wife wouldn't be able to sleep. So think about what you feel like you would need if there was something. I mean, you should be thinking about that anyways if you get injured or so, whatever it is. You want to always have that rainy day fund, but the low-hanging stuff, low-hanging fruit is, hey, work on a budget, understand where your money goes. It might not be the time to decide to take the family on a trip to Bali. Think about something that's maybe a little bit, if anything, if you don't do it and bad things don't happen to the economy, you can do it next year. It's delayed gratification, but you're putting you and your family in a better position because I have savings, I have money set aside for emergencies, and then I'm still taking care of my responsibilities, food and shelter, et cetera.
Yep.
So, it's like what we do. When we're planning, we're not planning for the best market. We'll just assume that the market gives you 8% per year because we know the market doesn't do that.
Exactly.
We're saying, let's plan for the worst markets.
Yeah.
So that even if that happens, you're okay. Same thing with spending money, setting aside for retirement, et cetera.
I like it. I relate a lot. I spend a lot of my time advising on 401k participants and working with them, and I see two things that drive me a little bit crazy. And they're, one, fear, and then making rash decisions and selling in a market like this. And that's pretty much the worst thing you can do. Staying invested, that's key. Making sure your employees have a tool or a person they can engage with who will make sure they do that, because that's the biggest mistake you can make.
Oh, on the 9th,
Yep.
the next day, I made sure that everyone called their clients and said, if you're in cash, you should
Get in
invest
today.
some into the market.
Exactly. Yeah, it's the worst time to sell. But on the flip side, there's also a lot of Instagram advice that says, this is a super cool thing. I also hear a lot of what individual stock is great. What should I be doing that's really creative? Fundamentals, diversification, 401ks are designed for success over the long term. You don't need to be too creative to be financially successful. So sticking with the basics, I think, is really important for that success, especially in a market like this one.
I agree. I mean, look, I did it for my sister and her husband. As long as you're diversified by geography, by size of company,
Yep.
And then you have a little bit of bonds, maybe a little bit of commodities, something different that gives you different return sources, and then I wouldn't always say set it and forget it, but you're a lot better off if you don't go in and try to make the tweaks.
Yeah.
And because you're thinking about it, I'm assuming that this audience is anywhere from 25 to 65, that you've got a variety of different time horizons.
Yeah.
If you're 25 years old or 35 or 45 or even 55 and you're not going to retire for another 15 years and you're selling because of fear, that the market, look at what happened in the market. We're back where
You're
we
gonna
were.
miss the best days.
We're flat.
Yeah.
So just try to take the emotion out of it and be diversified in the portfolio so you don't put all your eggs in one basket. I mean, I think there's many dealers that don't just sell one model or one brand. Why? Because the consumer
Too much
demand will
risk
ebb
in
and
one
flow.
place. Yep, absolutely. Well, Kendall, is there anything I missed on your end?
I think one thing that dealers can think about now as well is thinking about what are different ways that you can leverage your existing infrastructure, your existing buildings, and are there ways to creatively sell more products to existing customers in the sense of bundling service contracts, meaning that I think there's a consistent, or it's kind of standard to have oil changes and stuff like that, but maybe looking at brakes or tires or alignment. Is there additional education that you can provide consumers in terms of tariff smart car buying opportunities? As I mentioned before, a consumer who feels educated by their, I guess, the product offering creates so much loyalty. And the more that they feel savvy and they got that information from you, the more opportunity you have for a sticky customer. So I just say, sitting down, those are two examples of taking time out of the anxiety of this environment and maybe the day-to-day, and spending a day with your leadership team and really thinking outside of the box. It may seem far-fetched, some of the ideas, but oftentimes those most far-fetched ideas are what creates amazing opportunity within your dealership and your community that could very much diversify your offering within wherever you're serving. So I think the biggest thing is trying to take a step back, observe, orient yourself, and create some strategies. Lean on your advisors, lean on the people that you have that can give you third-party perspective, and then really engage your leadership team and your business, the people that help drive your business, to involve them to create that supportive team environment and remove anxiety, because anxiety is incredibly distracting. to what you're wanting, to what the long-term business goal is. And then they bring that stress home. They bring the stress to work. And I know as a lot of the dealers we work with really care about their employees. And so I would say the majority of dealers out there care about their employees. So what can you do to mitigate some of that anxiety?
The point I love that you made was communication. I think what sets our firm apart, and I'm sure other firms do it as well, but the advisors that call when it's a hard time to call. When the market's down 9% and the advisor calls and says, look, this is explaining what's going on, market's reacting to the worst case scenario, great time to put that cash to work, who don't hide. I was in the military, and if you could explain it to everyone, you would. And if they understood that and they knew they'd understand what their role in what we were doing was. Same thing here with clients or with the people that work at a dealership. If they understand we're all part of a team, that, look, I'm going to give you as much information as I can. Don't treat it like it's above your pay grade. Treat it like, hey, we are a family or a team. I know many of these are family-owned businesses. That's important. Those are people who are loyal that are going to help you grow your wealth. Communication, I think, is key in my business and in your business.
Yeah, absolutely.
Absolutely. Yeah, those are key takeaways. Take a deep breath, communicate, stay invested. Well, I want to thank everyone for being here today. Again, this is Kendall Rawls, Todd Bix, and I'm Hannah Sears, and there'll be more to come.